Wonderful. Thank you all for being back in such a timely manner. I think we can really tell that we're in Switzerland and not somewhere else in the world. All right, so we have one more session before we head to lunch. Here connecting CeFi and DeFi. We have Bitcoin Suisse and Liquidity here today. Who do we have here? We have Chris, Oliver, Robert, and Michael. And I think Michael is going to kick us off. So stage is yours.
Hi, everybody. Great to have you here. In the next 45 minutes, we would like to show you how you can build bridges between CeFi and DeFi, illustrate that on a really concrete use case. And I think, to my knowledge, it's the first native DeFi loan paid out in cash to a CeFi user. The next 45 minutes, you will know what that means. How do we structure it? In the first part, we'll talk about the DeFi part. So that's Liquity. So I'm Michael, I'm COO of Liquity, and we have Robert over there. He is the founder and CEO of Liquity. We will explain you what the protocol does, and then our colleagues from Bitcoin Suisse will show you how they bridged it and how they made a CeFi offering out of that. First, about Liquity. Liquity is an interest-free borrowing protocol. So a decentralized borrowing protocol on Ethereum, which provides interest-free loans against Ether, your collateral. I think it's a wonderful thing to already have here interest-free. You know, something in CeFi, you have to scratch your head. How's that possible? That's the fascinating world of DeFi, and you're going to see what that means. Decentralized borrowing, so these are smart contracts running on Ethereum on its own. And as a user, I can go to these smart contracts and take out a loan. To illustrate that, let's make an analogy to something you may be more familiar from TradFi. So probably you know Lombard loans, margin loans. You have a securities portfolio, you have stocks or bonds, and your bank gives you a loan against it. So you have an over-collateralized loan. With Liquity, we do something very similar, but in the crypto space. So if you have Ether, you can provide the Ether as a collateral to the protocol. The protocol provides you with a loan in our own stablecoin that's called LUSD. And the difference is also on the left side, you have a bank or a provider. On the right side, you only have the protocol. To give you also some context before we deep dive into the protocol, Liquity is a project that has been live for more than 12 months. I think it's really amazing. In these 12 months, the protocol has issued more than 4 billion in loans and managed that autonomously. No back office. It just runs on the blockchain and made 28 million in revenues. I think that shows you the power of DeFi and globally rolling out the product. Currently, the protocol holds 800 million in custody, you could say. We are very proud that we are #1 on DeFi safety, so that's independent scoring of kind of the security or how well the protocol is made. And interestingly, we are just a team of 9 people that pulled that off. So I hope that gave you a bit of a context. I would like to give now the word to Robert, who will deep dive into Liquity itself.
Thank you, Michael. Hi, everybody. So yeah, let's dive directly into the use cases offered by Liquity. So Michael already mentioned our main use case, which is giving out interest-free loans. Those loans are given out against Ether, used as collateral. So you have to kind of secure the value of your debt. But the cool thing is that this loan is interest-free, but then there is only like a small one-off or upfront fee that you need to pay as a borrower. And regularly, this fee is 0.5%. It can go up in some situations, but normally it's only this 0.5% fee. And this is fixed, so the terms are there. They cannot really change, so you wouldn't kind of need to pay more. And you also have the ability to kind of keep your position open as long as you want, which means there is no such thing as a repayment schedule. There is no obligation really to repay your loan. The only obligation you have is to make sure that your loan remains sufficiently collateralized. Now, what does that mean? In our case, it means 91% LTV, or loan-to-value ratio, so you can take out up to 91%, again, like of the value of your collateral, or to turn it around, we usually in DeFi, we say it's 110% over collateralization that you need to maintain. And this low minimum collateralization ratio basically allows you as a borrower, if you want to do that, to do leverage. And leverage is possible by basically taking out a loan against Ether and then selling your LUSD, because the loans, they are given out in LUSD, which is our own native stablecoin. So you can then sell your stablecoin in order to buy more Ether, put back the Ether as collateral to your position in order to borrow more, and so on. By repeating this, you can leverage up your exposure to Ether by up to 11%. And then last but not least, we have a very interesting yield opportunity, which kind of arises naturally, like from the way our system is built, because we have something we call a stability pool, where people can put their LUSD into the LUSD, the stablecoin that our system mints itself, can be deposited to the stability pool, and then it would earn a yield. And this yield has been historically between 5 and 18%. But it not only earns yield, it also acts as a, how should I say, security, or as a way to secure the other loan. So we'll see how that works in a moment. So yeah, this is basically, these are the three main use cases. And I want to just highlight here one use case, which is taking out a loan. Simply, like, you already own Ether, you are a long-term believer in Ether, but you also need the money because you may want to buy a car. So we had this use case. You also had other people buying real estate, like using a liquidity loan. So basically what they can do is they put their Ether into our smart contracts, they mint their own currency, they basically take out the loan in LUSD all by themselves, they sell this currency on an exchange. Currently it's Gemini, where you can basically directly off-ramp into fiat, like US dollars, and then you can buy your car or whatever you want. So that's the borrowing use case, no interest. And there is one other kind of interesting part of our system, which is that it runs on multiple front ends. Or to phrase it differently, we are not running a central front end for decentralization reasons, which means that there are multiple front ends, multiple other projects, integrators of liquidity, which offer you a gateway. Bitcoin Suisse is a bit of a special case. We will see how that works, but there are other, like, more DeFi native front ends that offer you a gateway to take out a loan. So, and you can choose the one that you like from a list. So let me highlight just a few key benefits and how they work, or how can we achieve those benefits. Like, without going into too much details, I just want to say a few words how they work. Like the interest-free part, I mean, you may scratch your head, how is this even possible? It is possible mainly due to the fact that the system can mint its own currency. So what that means is that we don't have to source it from somewhere else. There is no lender. We don't need to kind of go to third parties to borrow the LUSD or whatever currency we want to give out to our borrowers, because the system can simply print its own money. So that's the simple explanation. There are more details to it, but I can maybe talk about them in the questions part. The second benefit, so to say, is how can we achieve this 110% minimum collateralization ratio? So this seems pretty low. I mean, if you compare it to existing products like with Swissquote or banks, I mean, you usually have, I think, between 60 and 70% loan-to-value ratio, which translates to maybe 150 to 180% over-collateralization, if you just turn the numbers around. So how is this possible in our case? Well, there is one thing which is very important, which is speed of liquidation. You know, in case of margin lending or secured loans, you need to be able to liquidate the collateral in order to repay the debt if the borrower doesn't repay himself, or if the kind of collateralization drops below this threshold. So we need to be very fast. And that's exactly what we achieve in our system, thanks to this stability pool that I mentioned before. So the stability pool, you can think of it as an insurance pool. People who already own LUSD, maybe they are borrowers or maybe they just bought the LUSD on the secondary market, they can opt in and basically deposit their LUSD to this stability pool. So now, when the system detects that there is like a position, a borrower that is underwater because his or her collateral has dropped below this 110% value of the debt, what the system can then do is simply take out the amount of LUSD that is needed to repay the debt from the stability pool and burn it. Because I should say that normally when somebody repays, the LUSD that are kind of paid back to the system, they are burned. So the system kind of mints the money by giving out loans, and it burns the LUSD whenever somebody repays or whenever somebody is liquidated. But then it's not the borrower's LUSD that's burned, but it's the stability depositor's collective kind of LUSD. Now, why would somebody become a stability depositor? Well, there are two things here. There is a liquidation gain because the stability depositor would kind of receive the ether. Like the collateral from the liquidated borrower is then distributed among the stability depositors. So that's one incentive why you want to become a stability depositor, because there should be like a roughly 10% net gain in the end. And there is also another incentive, I think I will skip for now, but that's basically what allows the system to reduce the collateral ratio to 110% versus other systems that have 130 or even 150%. Like MakerDAO, if you know it, has, they have multiple layers, but the lowest is 130, the highest is 170. And then one other aspect that Mike already mentioned, I really want to emphasize it here again, is how autonomous and decentralized Liquity is. There is no administrators, like we as a company have zero way of interfering with it. It just runs on its own according to the rules that have been preset when we deployed it to the Ethereum network. There is also no governance, so there is nobody who could vote on changing parameters. So the fee that I mentioned, this upfront fee of 0.5%, is automatically managed by the system. It can go up in certain cases, but this is not due to a vote or anything. It's automatically managed. And it's also really fully decentralized due to the fact that the front ends are also decentralized. So I mentioned there are multiple kind of gateways to our system. So if one of them goes down, there are still many others that would allow you to access the platform. And maybe last but not least, it's maybe less obvious, but it's also the case that the ether that is put into the system and the LUSD that is put into a system by the stability depositors, it's there in the contract, it's non-custodial, so it doesn't belong to any entity really. It is owned by the smart contracts or just held by the smart contracts, and so that's why we say it's completely non-custodial. And immutable, which means that the rules, they have been kind of set up at the beginning. Yeah, that's basically it. If you want to learn more about Liquity, we have a number of resources. You can go to our website, liquity.org, and you can also check out other resources. So we have a very detailed doc section with some community resources as well, and videos and explainers and tutorials. Or you can go to our Dune dashboard, which is very interesting because it provides you like a number of statistics that really make the whole system transparent. You can see how the TVL, how the loan volume, how the interest, or the borrow fee kind of evolved over time. Yeah, I think that's it from my end. And yeah, I would like to give the word to Chris.
Yes. Yes, so after first introduction of the protocol itself, let me welcome you all also from Bitcoin Swiss side. At Bitcoin Swiss, we put the client first. That's why we start with the benefits for the client. I'd like to outline a bit why we've chosen Liquity protocol for this offering, our first DeFi offering at Bitcoin Swiss. So the why. Most client benefits is more or less because the client itself can still stay directional, so keep his ETH exposure and add additional liquidity. There's only, as explained before, there's only a one-off fee as per protocol, the 0.5 currently percentage. So pretty cheap, especially if you hold a long-term loan in the protocol. It's immutable, as also mentioned before. It's probably the most decentralized DeFi protocol, fully decentralized, no governance, immutable, and of course, permissionless. So also for Bitcoin Suisse, a good case of bringing DeFi permissionless. And it is safe, so lots of security in the protocol because of the over-collateralization and the stability pool, as mentioned before. We as Bitcoin Suisse, we add some additional client benefits to the overall offering, such as a mitigated private key risk, of course, so we handle the private keys. Then there's a delegated operational and mitigated operational risk. So overall, the interaction with the protocol is done by blockchain experts, which do this on a daily basis. For some clients, this is important. And of course, there's a direct conversion also from the native LUSD, the protocol's native dollar or stablecoin, at Bitcoin Suisse. So we add this to the overall service offering as well. And most important on the list, actually, we offer monitoring. So in case the collateralization level of the overall protocol drops, we have the opportunity or are able to call the clients, ask for recollateralization in the trough, in the liquidity trough. So there's another security for the client of always, at any time, having enough collateral in the protocol, even in tough times like now. And of course, reporting to the client. Secondly, why it's perfect for us, for Bitcoin Suisse, why it perfectly fits our overall product strategy. Well, it helps us in strengthening our position as a gateway, as an access to DeFi, in giving access to DeFi loans to our clients. Secondly, it is a scalable solution. That's quite important for Bitcoin Suisse as well. It saves on our own liquidity, because so far in the collateralized loans business at Bitcoin Suisse, we use our own equity, so we lend out our own, basically, which does not scale from a certain degree, of course. So it's a perfect match for us in order to have a scalable solution that saves on our own liquidity. And also from an AML perspective, that's important in regards to compliance, the anti-money laundering or money laundering itself risk is very small, is very limited. That was an important aspect as well in bringing this service. Then, because of the protocol, we have no counterparty risk. So we kind of have a counterparty risk with a fully decentralized, autonomous, and immutable DeFi protocol, but we can handle this in case of counterparty risk. Of course, it's additional revenues for Bitcoin Suisse. So there's a servicing fee, a monitoring fee, there's a brokerage fee, and there's an order fee when opening up the trough. What's also very good for Bitcoin Suisse is the client's ease, so the collateral is still with us. That's actually also highly demanded from our client side. They want to have their assets with us. It's balance sheet neutral from a rather corporate finance point of view. It's balance sheet neutral for us, and also in our special setup with the bank guarantee, which we have with Bitcoin Suisse, it's bank guarantee neutral. That's also a very, very good match for us. Yes, I'd like to hand over to Oliver.
Thank you kindly. Hi, everyone. Before we go next, now let's recap a bit what we have seen. So we've seen liquidity, what it is, and we now have seen presented by Chris on why we're doing liquidity for the client and also why it makes sense for us. Now, how about we look a bit on the how we're doing that? Now, this slide on the left-hand side, as you can see, we try to have it as simple as possible for the customer. So what we actually need from the customer in terms of instructions is how much ETH he wants to pledge, how much LUSD he wants to get, and whether he wants the LUSD to be converted. Now, with these instructions, everything else is basically outside of the client's sorrows and worries because we are taking over. So what we are doing there basically is the whole protocol interaction, all the private key generation, interaction with the market. The right-hand side of this slide is quite simplified. Why? There's a lot of transactions involved, there's a lot of checks involved that we need to do to make sure we are interacting with the right smart contract, that the addresses are fine, all the operational risk we need to cover. So that's basically how the setup looks like. Now, if we go and look a bit more in detail, this was basically our homework. So as you can see, this is our risk assessment. Just a little disclaimer here, it's not the complete risk assessment, so there's like some factors as well. But this is like the ones which we deem most important to have a look at. We're starting with the technical risk. I mean, obviously the code itself needs to be proper. It needs to be audited. It's not only looked at by us, but there's an audit report which we are going to check. And also we're looking at the history. So for us, since we are connecting now our brand with a product in DeFi space, I mean, we all are aware that in DeFi also things can go wrong. So if we're going to promote this to our clients, we want to make sure this doesn't happen. So that's the technical side. Here as well, we had a lot of our techies which were looking into this protocol to make sure we really know with what we're dealing here. Then from point of centralization, Robert already pointed out how decentralized Liquity is. There's no governance. Oracle is Chainlink, fallback teller, so that's a pretty safe setup there, and it's not upgradable. So we know what we're dealing with. The client knows what he's dealing with, especially important because the client holds the smart contract risk. Bitcoin Swiss is not a counterparty in this setup, but is a facilitator. So the client has a smart contract risk with the protocol. That's very important to understand. Then obviously there's economic risks connected, and there it's already starting where our service comes into play. So for a DPEG, Bitcoin Swiss doesn't have an active role. So we looked at how the pegging works, what's being done there, what are the fallbacks there, and we are considering it as safe as it can get with regards to this, to taking a loan based on ETH. Then on the liquidation side, that's then our strong play. So you don't want to get liquidated. You will lose about 10% of your ETH if you get liquidated, so that's something you want to avoid. Also, you probably will need some sleep every now and then, so you won't be able to constantly monitor your own trough. So that's where we come into play. So we've created an automated monitoring system, which is running 24/7, and it's basically pushing us notification whenever a trough is getting to a level which is close to the warning levels agreed with the client. So this as a service, we then would engage with the client and make sure that we can avoid any outcomes that's not in the client's benefit. Also, in terms of collateralization ratio, Liquity itself, the peg lives actually from the over-collateralization. And we don't want, or we recommend to our clients to take a rather low-risk approach here and have a collateralization rate of about 225%. So normally that's where we would say, look, that's the first warning level. If things go south, you should have enough time to react accordingly. Okay. Then another thing which might be very important, if you're an LUSD holder and you don't put it in the stability pool, you might want to sell the LUSD versus any other asset. And there, obviously, liquidity, that's always the same with liquidity. There you want to have enough liquidity in the market so you can actually convert your LUSD into the desired currency and buy the car, if you will. On the systemic risk side, we also analyze the third parties. So because of the full decentralized setup of Liquity, there's front ends that we need to use. So obviously this is also something which you want to check. Also check whether they are fit and proper. Is there fallback options? What are the alternatives? So we make sure that we can actually interact with Liquity, also in times of stress or outages. Okay, systemic risk, the recovery mode. Recovery mode kicks in if the overall collateralization rate of the protocol is going below 150. So that means that the majority of the troves, or the higher volume of the troves, has less collateral than 150, and then the protocol switches into the recovery mode. What does that mean? If you're a trove holder, you have the risk of getting liquidated even if you're above 110% for the protocol stability. So obviously that also requires us to monitor the protocol itself, which we're doing with the same system we built. As soon as there's some predefined riskier levels or alert levels, we are getting notified. We are immediately notifying our clients and with an action plan and with recommendations. Okay, and blockchain, I mean, that's quite an obvious one. So a systemic risk also, if you're having an Ethereum-based protocol, then if Ethereum is going down, then you're probably likely also experiencing an outage. On the legal side, we had a lot of discussions. We had like many calls with lawyers internally, externally, to make sure that this setup we are providing is sound and proper also under the current regulations. As far as I'm aware, we are the only ones who are doing like a DeFi product in terms of facilitating DeFi as a CeFi. I don't know of our competitors where there is a similar product. This is not just buying a DeFi coin and holding it in the wallet, but this is actually interacting with DeFi. So this is regulatory new territory. We have then obviously checked the KYC and AML requirements, where we came to the conclusion there's no counterparty, and Bitcoin Suisse is not a counterparty in that setup. The KYC requirements and the AML risk is rather low. AML risk as well, why is it rather low? If you pledge your ETH into the trove, once you close the trove, you get back the same ETH. The protocol is not using these ETH for anything. So it's the same, which makes it rather safe from an AML perspective. Yeah, then litigation. Obviously, this is a new service, so we had to put a lot of thought on how can we reflect that in a contract. Make sure the client is aware of the new risks he's taking. Make sure, obviously, of the benefits. That's the easy part, and also make it bulletproof in terms of any litigation. So this is like the legal part here. This was like a major milestone for us also. And then obviously on the operational risk side, smart contract interactions and transactions. This part, nowadays it's easy to be scammed. So obviously, we want to make sure that we have the right middleware in place, that we have the right smart contracts we're interacting with, we work with the right addresses, and that that we are not affected by any malicious activity that could happen on the blockchain itself or by malicious actors. And in the end, yeah, private key, I mean, this is a never-ending story. And this also connects a bit, CeFi and DeFi is kind of a bit of a paradox. Why do we need a CeFi to facilitate DeFi? One is because of the simplicity. We can offer it in a very simple way with providing a lot of services with that protocol. And the other side is security, right? So we have an institutional grade process where how we share the keys, which makes sure there's no possible loss of these keys, so they're available at all times. Plus also there's not a single person who can access it by themselves. So that's in terms of security something which we're obviously prioritizing. And that's also, I think, one of the crossovers where it totally makes sense from CeFi to DeFi to interact with each other. Right. So that's already it. So I'd like to ask my co-speakers back on stage, please, because we would love to take your questions and hopefully be able to answer them. Right. Yes, please. Okay, so for the streaming community, the question was, what does it interest us? What happens with the LUSD? What are there economic use cases for LUSD itself, or what happens to these LUSD? I think I'll take the part for anything else but the LUSD use cases. So, frankly, if the client wants any other asset we provide at Bitcoin Swiss, we don't really care what he's doing with this money. Buying a car, financing his running costs, leveraging it for other crypto investments, that's up to the client. So the only service we provide there is basically exchange these LUSDs into the asset he wants. As for the LUSD use case, you want to take that, Robert?
Yeah, maybe Michael can also jump in on that, but one type of use case is in DeFi itself. Like in the DeFi space, there are yield aggregators that are kind of yield farms where LUSD can be put into and earn a yield, let's say on Yearn or Pickle and some others. I mean, of course, LUSD is also listed on DEXs, like decentralized exchanges, and on some centralized exchange, like now Gemini, but hopefully there will be more in the future. So that's a kind of DeFi and a bit the centralized exchange space. We also have a more like kind of other types of integrations maybe you want to touch upon.
Yeah, for example, we're working on integration with lending protocols, so you can also then use it to lend against other assets like Compound and Aave. This takes a bit longer. But the idea is, like other stablecoins, we said Maker, or you have other stablecoins, to integrate that into the DeFi ecosystem, so the user gets the whole product suite he's used to. Yeah.
And maybe one last point is we also just got integrated with a project called Mover, which allows you to pay credit, which allows you to basically top up your credit card. You get a credit card and then pay with LUSD, basically.
Cool. Thank you for the question. Yes, please. Sorry, say again, the
Pegging.
Okay, yeah, a question about pegging mechanic with LUSD. Right on to you.
Okay. Maybe I can take it, and maybe if I can go back, it's a bit easier because I have a backups, or the backup slides in the end. Yes. So it's an involved question. So there are a number of mechanisms. The basic mechanism that makes sure that the LUSD shouldn't really drop below a value of $1 is what we call a redemption. Redemption allows any holder of LUSD to exchange the LUSD at face value for Ether. So it means, let's say you own 1,000 LUSD, the protocol would allow you to exchange it into $1,000 worth of Ether. So this means whenever the LUSD would drop below the peg or the parity line, there would be this kind of arbitrage opportunity to redeem it for kind of the exact like face value. By redeeming, the LUSD supply gets contracted, so that also helps like by monetary loss to kind of strengthen the peg. There is also a similar mechanism at 1.10, because when you are above, like when let's say the LUSD is completely overpriced at 111, you could basically take out a loan at the minimum collateralization ratio at 110% and make an arbitrage gain by simply selling or directly selling your LUSD. So those are like the two boundaries, kind of a price floor and the price ceiling. In between, there is a bit of a wiggle room, but there are also soft mechanisms, which basically mean that when the peg is higher, it makes more sense to borrow. When the peg is lower, it makes more sense to repay. So yes, but there is some, it's not like kind of 100% guaranteed that it's always $1. If that answers your question.
Awesome. Over there.
So the question is whether there is a risk of cascading liquidations when there is a very sharp Ether price drop, and what happens then. So I think we need to differentiate two cases. One is the case that you already mentioned, Oliver, which is this recovery mode. So when the overall collateralization of the system drops below 150%, there will be liquidations up to 150%. So basically, the system could wipe out all the positions that have a collateral ratio below this 150% threshold, which is pretty extreme, but it's kind of a measure so that the protocol can save itself. If that doesn't happen, like in the normal kind of operation mode, it's only those positions that fall below 110% that are liquidated.
Right, gentleman in the red. Okay, another question, I guess, for Liquity. How do you facilitate protocol updates if it's immutable?
Very good question. I mean, there is an obvious tension here. I mean, it's not possible to upgrade easily. I mean, it's not possible to upgrade at all in a strict sense. What we can do is, of course, deploy a second version in parallel, but then, I mean, there would be two versions of LUSD. So the way we think of it is that currently we don't really see a need for upgrades. I mean, it has been running for 14 months now without like any bigger issues. But of course, maybe in the like longer term future, at some point we will kind of see that there are improvements and we want to put out a new version. In that case, there is this migration option that the people would basically close their loans on the current version and reopen them on the new one. We could facilitate that like by kind of providing an easy way to do that in one transaction on the UI. But it will be, I mean, more difficult, of course, than for protocols that can simply upgrade their current system.
Awesome. Yes, please.
Is there a percentage catch for how much of the position can be liquidated in a single liquidation? And if yes, how do you prevent people from sort of liquidating up to that percentage just below and then running a second liquidation that comes after and liquidates much more than is actually necessary in order to go back to a reasonable overcollateralization?
Good question.
Okay, the question, it's a good one. So the question is basically whether there's like a percentage border which makes it possible to just liquidate until a certain percentage which is below the recovery mode threshold, and then liquidate another loan in order to kind of take advantage of the recovery mode feature, if that's formulated more or less correctly. Okay.
Cool, thanks because I wasn't sure whether it refers to recovery mode or not. So in that case, I mean, the system, like after every liquidation, and by the way, liquidations can be done in series. You can send one transaction which would liquidate up to 100 or so positions in one go, so it's pretty efficient. So, but the system would always, like after every liquidation, kind of check the current threshold. So like every liquidation should have a positive impact on the overall collateralization ratio because you're removing like the lowest ones, and then stop basically when it reaches the 150%. I'm not sure if that was really...
So you are stopped. So let's say I try to liquidate 50% of my position, but I only need to liquidate 30% in order to get back to a healthy position.
Oh, yeah, then I misunderstood, sorry. Then the question was maybe like whether there are partial liquidations which just restore like the individual collateralization ratio of a position. So that's not the case. I know there are protocols like Aave and others that have something like that. In our case, we didn't do that because we are already very kind of low with the 110%. So, I mean, technically it would have been possible, but when we run the numbers, it wouldn't have been like too much of an improvement and just added complexity. And we also think that this 10% that you lose in case of a liquidation is a good penalty also to kind of scare people a bit. I mean, people should be aware of that and should behave accordingly. So by being even more generous, maybe we would lose this kind of driving force. So.
Awesome. Maybe one last question before lunch. Yes, please. Okay, so the question is the revenues the Liquity protocol generates with the minting fees, 28 million currently, roughly. What is it used for?
Yeah, as Robert said, the fees are managed by the protocol, so they are not going back to the company. It's running autonomously. So that's then the purpose of the secondary token. So there's a protocol token, LQTY, which helps to incentivize the system. So stability pool depositor get that as a reward to contribute to the system. Front-end provider can get that. And once you have the token, so the user can stake it into the protocol, and then it's distributed to these stakers of the token. So it's like a closed ecosystem and revenue loop.
Okay, and I think with that we'd like to close. If you're still hungry for more, please come visit us on our booth. We are very happy to have a chat with you on liquidity, on other topics. Just come visit us, and in the meanwhile, please enjoy lunch. Thank you very much.